begin with Joe Nocera. He is one of the best business reporters writing today. He has a new book called A Piece of the Action, How the Middle Class Joined the Money Class. It is about the rise of sort of the personal finance world of today and how the people who shape that world. Before we talk about this book and the consequences, I also want to take note of what is being reported in the news today, a very big story. It is Orange County, California, the home of the Angels, the home of conservatism in many ways. Orange County, California has filed for bankruptcy because of some investments that they made over there, and I want Joe Nocera to help me understand this before we go on. What is going on in Orange County?
Well, it's actually very simple. What should be a very conservatively managed fund was not managed conservatively. Yeah. It speaks to one of the great issues in modern American life, which is that people, whether they're governmental organizations or individuals, want more yield.
Right.
And so in the last couple of years, as interest rates have come down, you start to stretch for yield. Well, how do you do that? You get into some derivatives.
What's a derivative?
A derivative is a derived security. It's essentially an interest rate bet. Mm-hmm. You're betting, if you buy one kind of derivative, you're betting that interest rates will go down. If they do go down, you make more. Mm-hmm. So instead of having to be satisfied with 2 or 3%, all of a sudden you're at 5, 6, 7, 8%, and that feels a lot better. And what happened in Orange County was this fund became so popular, and this fund manager became so well known as a yield chaser and a successful one, as the strategy worked for so long, that all these other municipalities threw him their money also.
Now, you're talking about Robert Citron, is he the guy?
Yes, that's right.
He was the manager of a public investment pool in Orange County, California. Right. He resigned as county treasurer after disclosing that his aggressive strategy cost local government $1.5 billion in potential losses.
The other issue, of course, is that his campaign opponent in the recent election ran against him precisely on the issue that he was taking undue risks with county money. And all of this was hidden. None of this came out until after the election.
And is Orange County representative of something that might be happening in a lot of other places, a lot of other funds maybe have been made?
They are poo-pooing this. The Wall Street types are pooh-pooing that aspect, but I actually think it is more widespread than we realize. In Minneapolis, you may recall, there was a fund, a government-oriented fund called, what was it called? It was supposed to be short-term government bonds. That sounds really safe, right?
Yeah.
It was peddled by Piper Jaffray. All these municipalities were in it. The Symphony was in it. The United Way was in it. And for 3 years, it did great. And now it's down 24%. It's the worst performing fund in the country in its category, and all these municipalities are saying, "Gee, I didn't know this was risky." So I do think there is a potential danger here that's larger.
Before I move to your book, also Bankers Trust. What's that about?
Well, the Bankers Trust business is they were selling the derivatives,
right?
And Procter and Gamble. I have a hard time believing that the financial gurus at, for instance, Procter & Gamble, which took, I think, a $120 million hit.
And then they sued Bankers Trust.
Then they sued Bankers Trust, saying, gee, we didn't know what derivatives really did. Come on, guys.
What business are you in?
These are some of the most sophisticated money managers in the country.
And what's going to happen there? They have
I think Bankers Trust has already settled with 2 of the 3 people who've sued them. They haven't yet settled with Procter & Gamble, but I suspect they will at some point.
Now, what you're saying here in this book is that the middle class, everybody's becoming a financier in some way. And you go back to 1958 with the first credit card. The nation's first successful bank credit card is issued by Bank of America. 19 years later, Bank Americard is renamed Visa. What's this about? I mean, you cite one thing after another, and you end up with mutual funds offering the middle class an opportunity to invest.
For better or worse.
For better or worse,
I might add.
Yeah.
The same thing with credit cards.
Right.
What's really happened, I mean, what the book tries to do is explain to you how your financial behavior has changed over the last 30 years and why. And if you think about 30 years ago, it's such a simple world. You go to the bank for a loan. Yeah. You don't invest. You keep your money in the bank. What do you get for it? You get 4% in the 50s, 3% federally regulated, right. No interest on checking accounts. Your most sophisticated financial transaction is a Christmas club.
Yes.
I mean, do you remember Christmas clubs? I remember them deeply when I was growing up. You know, you give a bank, and this is what you're doing. You're giving a bank an interest-free loan every month, which they can then, by the way, loan out at market rates, and they give you in return a toaster, plus your money back at the end of the year. That was high finance. That had its good aspects, one of which is you didn't have to think about your money all that much. But America was a different place then, and you didn't have to worry about your retirement, kids' college as much as you do today, et cetera, et cetera. So what my book documents is the process by which all this changed, by which finance became complicated, by which you had to take control of your own financial life, both on the credit side and on the investment side, and the events that took place that made that happen.
So in the end, is this good or bad?
The hardest question in the world. I mean, I actually think, look, it'd be great to live in the 50s again. I mean, in terms of finance, it'd be great to know that every year American productivity would go up, and you get a raise, and you didn't have to worry about being laid off.
This was a post-World War II boom.
Yeah, and that your pension was secure and safe, and that interest rates were stable. In that kind of world, you could have a simple financial...
The budget was about, I mean, the deficit probably was about what in the 50s?
Oh, there wasn't a deficit.
There was no deficit.
There was no deficit.
There was a balanced budget.
I mean, the deficit is a function of Johnson and
guns
Vietnam.
and butter in Vietnam. Yeah.
And, you know, here we are today. I mean, the thing about it is, there were moments along the way where the world started to get rocky. It started to change. Inflation started to bubble up, and it was, the money in the bank was untenable. That old world was falling apart. And, you know, there were moments where the government actually tried to force middle-class people to keep in the bank. You know, you're stuck there. You know, inflation could be 9%, but we want your money getting 4.5% because that's going to save the banking system. That's untenable. We can't have that. I mean, there would be blood in the streets. And what happened was, you know, middle-class people, you know, they're smart. They're not stupid. They saw that this wasn't going to work, and they started to look around, and where else can I put my money? I have to do something. I can't let this situation be. Yeah.
And it used to be part of the conventional wisdom that the little guy knew nothing. And when the little guy was buying, the big guys were selling, and the big, huge pension funds and all those institutional investors, they were the people who made the money. And by the time the little guys, and people would even look at the market to say, when the little guys move in, then, you know. Now, all that changed. I guess that became not a particular good way to look at things because the little guy is not in the market. He's primarily in mutual funds.
Well, I mean, mutual funds are the market, really. I mean, there's $2.1 trillion in mutual funds. That's a lot of money. That's our money. And in effect, the Main Street is propping up Wall Street now. It's the little guy, and this is, I mean, one of the great shifts in American life. The little guy doesn't cut and run. This happened this is what they found out in 1987. Market crashes 500 points, right? You know, program traders panic. There's no buy and sell orders on the street. The little guy is the one who held firm and who said, okay, the mutual fund companies, I've been taught to think long term. So I'm not going to panic. Let's see what happens. And what happened was the market came back in 15 months. I mean, they got lucky.
What's the best, what do your smart friends tell you about where the market's going now that we've had this tidal wave sweep over the American political system?
My smart friends say they have no idea what's happening. I mean, that's the truth. I mean, that's Peter Lynch's great line. Is to me, economics is whether Zaire's is improving its earnings, not whether the market's going up or down.
Peter Lynch, a great investor at
the great
Magellan
manager,
Fund.
Fidelity Magellan. And I've come more and more to really believe the value of that aphorism.
The main thing I remember about Peter Lynch is that he used to make all these investment decisions, he claimed, based on whether his wife liked the pantyhose or not, or whether he stayed in the motel a lot. I mean, it was all this sort of simplification of the process.
I mean, the fact of the matter is, when you meet Peter Lynch, you think this is not an investment genius. You know, there's something so totally normal about him. But when you actually watch him work, you realize that his brain is a market calculator. And if I can tell a little story, I mean, I saw him sign...
Because he's one of the people profiled here.
I saw him sign books in Chicago when his second book came out. A big bestseller. And there's lines out the door. And everybody wants to say, should I buy Starbucks? That was a hot new stock. Should I sell IBM? And he'd say, I don't know. And a guy comes in that he'd actually had money in the mutual fund, that he owned a company that Peter Lynch had stock in the fund. And they slap each other on the back and you know, oh, you made me a lot of money. Oh, you made me a lot of money. Oh, you know.
Yes.
So, but then Lynch looks at him, and the guy's in cellular telephone, and he said, so what about this Motorola deal?
Yeah.
So what about, you know, what's going to happen to cellular in Canada? You know, da-da-da. You suddenly realize, in a 5-minute conversation, Peter Lynch has learned more about the cellular business that will help his investment decisions than all the 300 people who've been standing in line to buy his book are going to get from reading his book.
Just from one conversation in 5 minutes.
Right,
yeah.
because that's the way his brain works.
And then, but shouldn't all those people then that are going to buy the book, then they should go buy Peter Lynch's mutual fund, right, that he's running?
That's what I used to argue to him.
Yeah.
You know, he would say, you and I can be as good in the market as I am. And I'd say, Peter, that's baloney. My argument to him is, look, this is the reason people come to you, because they're insecure about this, because they don't think they can do it, and because there's something very powerful about the idea that you, the great Peter Lynch, can do it for me. And that's the whole power of the mutual fund idea.
Most of the people you know on Wall Street, are they happy about what happened in the midterm elections? Not that it matters, but
I think they're
or are they
more
scared
nervous.
to death?
I think they're more nervous than you would expect. I mean, I think there's genuine worry about Helms and about Gingrich as you know, quote unquote bomb throwers. I think there's real worry that that a major tax cut. What does Wall Street worry about more than anything else? Surprisingly,
instability.
Instability, but also, I mean, deficit.
Yeah.
Deficit is an issue.
Wall Street wants to see the deficit reduced.
Right,
and whatever,
constantly.
Yeah. Therefore, if you raise taxes would reduce the deficit, they might be in favor of it.
They would be against it because you're raising taxes,
Right.
but they would also be against cutting taxes dramatically if it would cause
Increase
the deficit
Yeah.
to
If it
balloon.
would.
Wall Street, you know, there's less of the government in Wall Street than you would think. I mean, when the Treasury Secretary says something that causes the dollar to drop, yeah, that's one thing. But general day-to-day decisions made by the President and the Congress relating to budgets and so on doesn't affect Wall Street nearly as much as you would think it would.
What do you want people who read this book to come away with?
Oh, what I want I want the light bulb to come on in their head. I want them to say, oh yeah, that's why I moved my money out of the bank and put it in a money market fund. I remember when I did that.
Yeah.
Now I understand the forces at work here. Or I never knew two guys sitting in a room somewhere who were totally broke invented a money market fund that changed my life.
This book is not only about money market and mutual funds, it is about that, but it is also a look at how money markets work and how the middle class, because of credit cards and a lot of other financial instruments, have come to play a significant role in the financial life of this country. Joe Nocera, A Piece of the Action. We'll be right back. Eugenia Zuckerman, you know her from CBS Sunday Morning. She is also an outstanding musician in her own right.